There is no sure thing, and there's certainly no sure thing in investing. And when you hear about a sure thing, the best thing to do is run the other way. Well, the tech bubble was, Mark Twain said that history does not repeat itself, but it does rhyme. The themes rhyme, even though the details are different. The tech bubble was just like the Nifty 50. People believed that these were great companies, that they were going to change the world, and as a consequence, it didn't matter what you paid for them. And guess what? Collectively, they changed the world. The world has no resemblance to what it was 20 years ago, technologically. And yet, if you invested in most of those companies, you lost all your money.
Well, I think this is a really important point. I just want to emphasize that Howard has made. In the late 1960s, Merrill Lynch put out a report listing the 30 companies in the technology industry, and they were recommending the computer industry would increase 100-fold by the end of the century. Out of those 30 companies, within 15 years, only one was in the computer business. So they were 100% right in the enormous growth of technology in the computer industry. However, 29 of the 30 companies they picked were no longer either in business or in the computer business, I think, from that standpoint. And I remember, Howard, at that period of time when someone would want you to invest in a technology company, I said, well, it sounds interesting. Could we read it? And they would say, well, if you have to read it, you won't get a chance to invest because it'll be fully subscribed.
Sure.
Let's talk about the recent financial challenges and crises of 2007, 2008, Howard.
People ignored the cyclicality of things and came to believe that trees would grow to the sky and believe in permanent good times. The biggest single problem I was asked by the New York Times to write an article about the cause of the crisis. They asked a dozen people, and as you might imagine, they got a dozen answers. And my answer was an article called Too Much Trust, Too Little Worry. And basically, in the years immediately leading up to the crisis, 05, 06, and early 07, people came to believe that risk had been banished, and that the combination of the adroit Fed, which could fix any problem, the worldwide wall of liquidity coming toward us from China and the oil producers in the form of excess reserves, which would constantly buoy our stocks and asset prices, and the wonderful invention of Wall Street in securitizing, tranching, and selling onward, had eliminated risk and had sliced and diced it so finely and spread it so broadly that there really wasn't much risk left. So people stopped worrying about losing money. Risk aversion is the key element that keeps the market honest and sane. And when people are risk averse, they will do extensive due diligence. They will apply conservative assumptions. They will demand compensation for bearing risk. And all of these things are very helpful. But when they forget to be risk averse and then they drop their due diligence, they stop being conservative in their assumptions, they stop demanding protective covenants and adequate returns and risk premiums, and then prices get too high relative to reality, and that's when you get a bust. And that is what happened in 07, 08, in my opinion, more than at any time in my lifetime. It happened across the board. We've seen it before in different asset classes. In 88, there were 90 disk drive companies and so forth. So people that believed that the disk drive industry held the secret to sure riches. But prior to the crisis, they felt that everything was a way to get rich easy without risk, because risk had been banished.